Welcome to The Explainer. Today, we're going to unpack something absolutely crucial. We are decoding the hidden mechanics of a looming market crash and, uncovering exactly how these financial patterns repeat themselves. And hey, don't worry, we're doing this completely jargon-free. We're going to look directly at the data to cut through all the noise and figure out what is really happening behind the scenes in the current market. Let's get right into it.
Okay, let's dive into this. $2 trillion. That is the massive, truly staggering amount of wealth that was wiped out of the markets in a single day during the sudden tremor this past June. I want you to just let the scale of that number sink in for a second. 2 trillion. This wasn't some slow, gradual decline, right? This was an immediate, violent shock to the system.
So what was the catalyst for all this sudden panic? Well, it was a wave of unexpected doubts surrounding AI memory chip spending. And it hit the global markets incredibly fast. South Korea's Kospi index fell a staggering 10% in a single day, dropping so rapidly that authorities literally had to freeze the entire national stock exchange. Big, foundational players like Micron, they dropped 13%. Honestly, it felt like the floor was just suddenly giving way.
But here is where it gets deeply eerie. We've got a chilling historical parallel staring us right in the face. Think back to March 2008. The massive investment bank Bear Stearns collapsed. That was a huge tremor, right? A blaring warning sign, yet the market largely just shrugged it off and rallied. Now, fast forward to the AI tremor of this recent June, and what happened? After losing $2 trillion, the market basically decided the scare was over and rebounded to near record highs within weeks. It's like they're acting as if the massive warning never even happened.
Which brings us to Section 1, the delusion stage.
So why exactly do smart investors ignore these blaring red alarms? Well, it really boils down to FOMO, the fear of missing out. It's kind of like that little voice in your head justifying a second slice of cake you definitely don't need, but on a massive global scale. Your logical brain knows the truth, but that louder voice is just like, screw it, it's going to be fine this one time. Now imagine millions of investors feeling that exact same urge all at once. To see just how deep this delusion currently goes, we can look at what's called the Buffett Indicator. This is pretty simple. It just compares the total value of the U.S. stock market against the size of the entire U.S. economy. Warren Buffett famously said that when this number hits 200%, you are, quote, playing with fire. Well, our current record high, it sits at 238%. We have soared right past the dot-com bubble peak and into completely uncharted, historically dangerous territory.
And the expectations driving these insane valuations, they are sky high for sure. Wall Street is currently forecasting long-term earnings growth of around 25% a year for top companies. Companies like NVIDIA and Broadcom have been trading at well over 20 times their sales. And it is absolutely crucial to point out here, that's their sales, not their profits. Valuing companies at this level only makes mathematical sense if you assume their explosive growth will literally never ever slow down.
Moving on to Section 2, the AI illusion.
So, how do things get so incredibly inflated? Well, think about trying to read a super long, confusing cell phone contract. Eventually, your mind just gives up, you tick the box and you sign it, right? You create this massive blind spot. The market is doing exactly that right now with something experts call circular financing, and this brilliantly illustrates the problem. Let's walk through this loop together. Step 1, NVIDIA invests billions into OpenAI. Step 2, OpenAI takes that money and commits it to Oracle to pay for cloud computing power. Step 3, Oracle takes that exact same money and spends it buying computer chips from NVIDIA. See what happened there? The same dollars loop completely around, and every single time they pass through a company, they get recorded as brand new demand. It's estimated that around $1 trillion in deals might just be the exact same money being counted multiple times. It creates this total illusion of unstoppable growth.
Now, if this concept sounds familiar, it definitely should. We saw a very similar mechanism back in 1999 with a company called Lucent Technologies. Lucent essentially lent telecom startups the cash they needed to buy Lucent's very own equipment. They called it vendor financing, and man, it made their revenue look unbelievable. That is, until the startups ran out of money and couldn't pay Lucent back. As a result, Lucent's stock collapsed an astounding 99%. This brings us to Section 3, the invisible debt trap. Here's the thing. An overvalued market doesn't guarantee a crash on its own. A 10% drop? That's actually completely normal, and frankly, it's healthy. But debt is the hidden fuel that turns a simple drop into a 2008-style catastrophe. Today, that fuel is hiding in a corner of the financial plumbing called private credit. As you can see, private credit is lending that happens away from traditional banks. It involves big funds lending money directly to companies. And because it happens directly out of sight and entirely off the public books, everyday investors and honestly often even regulators just can't easily see the cracks forming until things are already fundamentally broken.
Now, what's really interesting about this slide is the undeniable rapid saturation of speculative risk taking place in this hidden market. Historically, over the last 5 years, AI-related deals made up about 17% of the private credit market. But look at the projection for 2025. It jumps to 33%. In a really short window of time, the entire world of private credit has become completely drenched in highly speculative, borrowed money that's just pouring straight into AI.
And the people who lend this money for a living? Yeah, they're starting to sweat. Morgan Stanley is modeling an 8% default rate in private lending if AI revenue doesn't materialize fast enough. UBS warns it could actually hit 15% if the disruption is severe. And one closely watched metric shows private credit defaults are already climbing to 6%. To put that into perspective, that puts current stress right up there with the levels we saw during the global pandemic. The foundation is absolutely shaking right now.
But here is the most paradoxical, mind-bending trap of this whole shebang. Much of this private credit money was actually lent against traditional software firms. The exact same firms that AI is supposed to eventually replace. So think about the logic here for a second. If the AI dream fails, well, the massive AI loans default. But if AI actually succeeds and replaces these software companies, the loans lent to those software companies default anyway. It's literally like flipping a coin and losing whether it lands on heads or tails. There's no way out.
Let's look at Section 4, the complacency trap. With all these red lights flashing everywhere, you gotta ask, why do smart people keep pouring their money in? Well, we're looking at an entire generation of investors who've been trained to believe a safety net will always magically appear when things go wrong. On Wall Street, they affectionately call this the Fed put. It's this deep-seated belief that the central bank will just always come to the rescue with rate cuts or emergency bailouts if things get bad enough. It is exactly like having a friend whose parents always bail them out of their mistakes with a blank check. Because they never have to actually face the music, they never learn to price in real risk. They believe they literally cannot lose.
Which brings us to our final part, Section 5, how to protect yourself.
The truth is, no safety net lasts forever. And while we can't predict the exact date of a crash, it is absolutely crucial to stay awake and adapt your portfolio. Based on 40 years of market experience navigating these exact kinds of cycles, here's a clear, actionable playbook to protect your wealth without panicking. First, stay invested. Trying to time the absolute top of the market is an incredibly expensive mistake. Second, diversify beyond the top 7 AI companies that everyone else is currently crowded into. You gotta spread your risk. And third, hold a meaningful cash position. If a tremor turns into a real crash, you want to be that calm investor with cash on the sidelines, ready to buy while everyone else is panicking.
Which leaves us with one final, provocative question to ponder today. I want you to genuinely ask yourself, are you prepared for the tremor to become an earthquake? We all felt the June market shock. The signs are there, the data is clear, and the history is written. Now it's up to you how you navigate it. Thank you so much for joining me for this explainer. Stay curious, stay prepared, and I'll see you next time.